Most people still carry the assumption that the banking system is some kind of immovable, fully stocked stronghold, as if the moment your money goes in, it settles down comfortably, waits patiently, and stays exactly where you left it, faithful and dependable, like a loyal pet. That picture feels reassuring, but it is not how the system actually functions. The uneasy truth is this: a significant share of what we call money is really just belief, backed by paperwork. And when that belief begins to crack, the assets that usually seem dull and uninteresting, things like silver, can suddenly behave as if they've been jolted by electricity. Because what we are witnessing in silver right now is not a standard rally. This is not a gentle climb of a few dollars that financial television can shrug off with a smile. Silver has been surging, snapping back, whipping violently, and dragging the entire precious metals conversation into an entirely new realm. And the part that truly deserves your focus is not only the price spike itself, it is what that spike is revealing about the hidden infrastructure beneath the system. It is Tuesday, January 27th, as I record this. Drop a comment and tell me what time it is, where you're watching from, because I genuinely enjoy seeing how many different time zones are tuning in and just how global this community really is. And very quickly, YouTube's own analytics show that a large portion of viewers watch these videos without ever subscribing. If you're getting value from this channel, please hit subscribe now. It's one click, and it helps far more than most people realize. Here's the plan for today. First, we're going to unpack what silver just did, and why the way people talk about spot prices and futures markets ends up confusing so many. Then we'll look at what dealers and delivery timelines are signaling, because that information is far more important than any single candlestick on a chart. After that, I'll break down volatility and standard deviation in plain language so you can stop getting emotional whiplash from every price swing. Then we'll zoom out to the bigger macro picture, the confidence issue, the debt issue, and why silver keeps forcing its way back into attention. And at the end, I'm going to explain the single mistake that can turn a winning move in silver into a losing one, even when the price rises. So stay with me. Let's begin with price, because I know that's what you checked before clicking. Silver has been trading around the 110 per ounce level after ripping above 117 and then snapping back hard. That kind of action is exactly why some people are cheering while others are panicking. And in fast-moving markets like this, rumors always travel faster than facts. You've probably heard the same narrative repeated over and over. Small investors are dumping their silver. Everyone is cashing out. This is the top. Yes, some people will always sell into strength. That's human nature. But here's the question that should make you pause. If the market were truly drowning in selling pressure, why did price just punch higher anyway? If supply were flooding in, why does the price behavior still look like the market is starving for metal? That contradiction is your first clue. When price surges, while the chatter insists everyone is selling, it usually means the demand isn't coming from the people you keep hearing about. It's coming from deeper pockets, bigger obligations, and sometimes from places you don't even notice until it's too late. And in a moment, I'll show you where that demand is actually showing up in plain sight. First, let's reset the fundamentals. Silver has a paper price and a physical reality, and people constantly blur the two as if they're identical. You have the futures price, contracts, leverage, margins, and large institutional flows. You have spot, the cash reference people quote when they say silver is at a certain level. And then you have the real-world buy and sell price when you handle physical metal, which is spot plus or minus a premium. In calm markets, premiums are just an inconvenience. In stressed markets, premiums become the whole story. Right now, that story is loud. In several overseas markets, silver has been trading at double-digit premiums above standard benchmarks, with some reports showing more than $14 over reference pricing. That is not normal behavior. That is the market telling you that metal is worth more in one location than another. And whenever you see gaps like that, you should ask a hard question. Why isn't this instantly arbitraged away? The answer is almost always a mix of friction, availability, and urgency. That's the first crack in the everything is fine narrative. Now, an important detail. Those overseas premiums are real, but they don't mean every physical silver market worldwide is empty. In some regions, physical silver has actually traded at a discount to futures prices. That tells you the paper market can overheat while local cash markets cool down. This is exactly why I keep separating these ideas. Futures markets can turn into leverage-driven games, while physical pricing depends on local demand, margins, and how quickly dealers want or need to restock. Now let's talk about the gold to silver ratio, because it's a quick way to gauge the mood. Gold has been pushing above $5,000, while silver hovers near 110, putting the ratio roughly in the mid-40s. That's a long way from the 80-to-1 world people remember from calmer years. But it's also not the ultra-low ratio you often see at the final blow-off phase of a mania. Translation, this move is advanced, but the tape is not screaming a clean "it's over" signal, and that's why the next phase could surprise people on both sides. Most people want one magic number, one ratio, one chart, one tweet that explains everything. Silver doesn't work like that. Silver lives at the messy intersection of monetary anxiety and industrial reality. One week it behaves like money, the next it acts like a manufacturing input. That split personality is why it can go from ignored to explosive so quickly. Now, about dealers. Over the past couple of weeks, multiple dealers have posted notices about unusually heavy activity, delayed shipping windows, and certain products going out of stock. I'm not claiming there is no silver anywhere. That kind of statement is dramatic and usually wrong. What I am saying is that pipelines tighten when demand surges, and tight pipelines create strange behavior. Pre-sale listings, delivery dates weeks out, sudden premium changes. This is where rumors cause the most damage. Someone hears "sold out" and panic buys. Someone else hears "everyone is selling" and panic sells. Both reactions are exactly how you hand your edge to someone calmer than you. You don't get paid in markets like this for being loud. You get paid for being disciplined. Here's a practical rule I live by. Don't trade physical silver like it's a stock. Physical metal has friction. It has spreads. You can be right on direction and still lose money because you paid a premium going in, accepted a discount coming out, then changed your mind and paid the premium again. In a volatility spike, that round trip can crush you. Simple example. Imagine you bought a 1-ounce coin when spot was $90 and your all-in cost was $100. Price rips higher and you sell when spot hits 110, but the buyback you receive is $97 because the dealer is protecting against risk. You think you made $20. In reality, you made $3. Then silver dips, you panic, and you buy back at spot 105, but now your all-in cost is $115 because premiums expanded. Congratulations. You just turned a winning move into a losing one, entirely through your own actions. That's why the smartest approach for most people is boring. Buy deliberately. Hold patiently. And if you sell, do it intentionally, with a plan, not because a headline or comment section scared you. And yes, you still need to do the homework. If you're selling, compare buyback quotes. Don't walk into the first shop and accept whatever number they offer. If you're buying, compare total cost, reputation, delivery timelines, and exactly what you're receiving. In fast markets, sloppy decisions get punished. Here's how I think about research in a fast market, and I want you to adopt the mindset, not necessarily the exact checklist. First, get multiple quotes on the same product at the same time, because premiums can shift within hours. Second, look at fulfillment. A great price with a 1-month delivery window is a very different deal than metal that ships in 2 days. Third, ask yourself what happens if you change your mind. What's the spread? What's the buyback policy? In stressed markets, that spread is the silent killer. Now here's where the narrative gets interesting. Many people keep saying retail buyers are driving this entire move. Retail can amplify trends, sure, but the size and speed we've seen suggests something larger is involved. I say that because the paper market and the physical market have not been moving in perfect sync. There are signs of stress in physical access, even when paper flows don't look like a one-way stampede. And here's a key detail that often gets overlooked. Some recent reporting suggests that the hottest buying hasn't necessarily come from the traditional Wall Street crowd. In fact, during certain windows, futures and fund positioning looked like net selling while spot prices kept climbing. That seems odd until you realize different groups act for different reasons. When you see that split, it hints that price is being pulled by a mix of retail speculation in some regions and physical urgency in others. So what does that mean? It means price discovery is getting messy. And when price discovery gets messy, volatility becomes the weapon. Let's talk volatility, because this is what separates people who survive from people who get chopped up. Silver's implied volatility has been extremely elevated relative to gold. That means the market is treating large swings as normal. This isn't just an options market detail, it's a warning label. Expect violence. When you see a chart that looks like a straight line up, don't assume it can't pull back. It can, and it probably will. Pullbacks are part of the process. They flush out leverage, punish late buyers, and test conviction. The market's job is to make confident people look foolish. Here's a framework that helps. Think in ranges, not straight lines. When volatility is high, the market can realistically swing from the 90s into the 1 to 30s over a short period without breaking the larger trend. That kind of move looks insane on your phone screen, but in volatility terms, it can still be within a normal band. Now let me translate standard deviation into normal human language. The market is basically saying, given how violent this has been, we need to price a very wide cone of possible outcomes over the next few weeks. If you were insuring silver right now, you'd charge a lot because swings that once felt impossible are suddenly routine. In practical terms, a 1 standard deviation range during a silver spike can be shockingly wide. That's why you see forecasts that include the mid-90s on the low end and 130s or even 140s on the high end, within a month. That's not insanity. That's just what the math implies in a wild market. And here's the key point. Wide ranges don't mean the trend is finished. Wide ranges mean the market is searching for a fair price and is willing to bruise you in the process. You'll also see gaps where price closes at one level and opens far away from it. Those gaps feel unsettling, and often the market revisits them, not because of magic, but because liquidity returns to unfinished business. When price moves too fast, it leaves levels untested, and later those levels often get revisited. Now zoom back to the physical side, because this is where volatility really hits. Dealers don't have unlimited balance sheets. Most are built to carry a normal amount of inventory for normal customers using normal credit lines. When the market turns into a fire hose, with buyers rushing in and sellers rushing out, dealers get squeezed from both sides. They have to pay up to secure product and protect themselves from whipsaws. That's when premiums behave strangely, buybacks turn defensive, and spreads widen in ways that shock people. This is also why "I'll just sell now and buy back lower" sounds smart, until you actually do the math. In calm markets, you might pull it off. In stressed markets, the spread becomes a toll booth. You can be right on direction and still lose because premiums expand, buyback discounts deepen, and you pay the toll twice. Trading physical silver during a volatility spike is like sprinting across a highway at night. Now here's the twist you need to remember. Volatility doesn't tell you direction, it tells you the size of the punches. Direction comes from fundamentals. And this is where things get uncomfortable for the paper system. Based on recently published inventory data, deliverable silver in key vault categories has fallen sharply over the past few years, with some measures showing registered stocks down more than 70% since 2020. Love that data or hate it, the implication is simple. In a squeeze, the margin for error is much smaller than most people think. Add the demand side. For years, the silver market has been grinding through tight conditions and repeated deficits. One major industry estimate put global silver demand around 1.12 billion ounces in 2025 and pointed to ongoing deficit dynamics. Deficits don't guarantee a straight-line rise, but they explain why the market can feel boring for years and then suddenly go feral when buyers show up together. And demand isn't just people stacking coins. Industrial demand is the quiet monster in this story. Solar panels, electronics, electrification, data centers. Silver is not optional. It's functional. Recent updates suggest solar alone consumes a meaningful slice of annual supply, often cited in the mid-teens percentage range. Combine that with every other use case, and it's clear why the market is so sensitive to disruption. But let me challenge the easy bullish talking point. People love to say industrial demand can't fall because the world needs silver. The world does need silver, but at high enough prices, manufacturers substitute, redesign, thrift, and delay. That's not bearish propaganda, that's how businesses survive. Some recent commentary has even warned that extreme silver prices can pressure industrial consumption where demand was already peaking. So the real bull case isn't silver only goes up. The real bull case is that silver is being pulled higher by monetary fear and physical tightness, with savage pullbacks as the market searches for balance. Now here's something most people missed. The futures ecosystem itself is adapting. The primary U.S. derivatives exchange announced a new 100-ounce silver contract designed to meet surging retail participation. That tells you interest grew large enough to force infrastructure changes. It's not a promise of higher prices, but it is a signal that the market is broadening beyond the usual professionals. There's another flashing signal unrelated to chart patterns: delivery behavior. When large numbers of contracts stand for delivery, the paper versus physical debate stops being theoretical. Recent chatter and data summaries have pointed to thousands of contracts standing for delivery in a single month, translating into tens of millions of ounces. That's not retail flipping coins, that's weight. The system assumes most traders want exposure, not bars. When that assumption weakens, the market has to reprice immediate metal access. That repricing shows up as wider premiums, tighter availability, and sudden inventory drains. Now let's deal with the rumor machine, because it's only going to get louder. You'll see posts claiming some royal family, sovereign fund, or mega wealth group is about to buy hundreds of billions worth of silver. Sometimes those stories are nonsense. Sometimes they're loosely connected to reality. Either way, you can't build a plan on rumors. What you can do is use them as prompts to check real signals: premiums, lease rates, delivery patterns, and cross-market spreads. Think about scale. Silver isn't a trillion-dollar bond market. It's smaller, which is why incremental demand can move it violently. That cuts both ways. Big buying can launch it. Big profit-taking can slam it. The move isn't just about being right. It's about being positioned so you're not forced out when the market tries to shake you loose. One recent analysis highlighted a short window in early January where more than 30 million ounces were pulled for delivery, a meaningful chunk of what was listed as readily deliverable inventory. I'm not saying vaults are empty, I'm saying swings get dramatic when large players choose bars over promises. That connects to another underappreciated signal: lease rates. The annualized cost to borrow physical silver has hovered around 3%, elevated compared to a balanced market where rates sit near zero. You don't get sustained lease rate pressure if supply is effortlessly abundant. That's scarcity being priced quietly. Now here's a timing wrinkle almost nobody mentions. Large holiday shutdowns in major trading hubs can trigger profit-taking, not because the thesis is broken, but because traders don't want exposure when liquidity thins. Some analysts have flagged risk around the long closure tied to the Lunar New Year. That's why you can believe in the long-term story while respecting near-term turbulence. And if you're wondering why gold matters, remember, gold's massive run has fueled the hard asset reflex. Gold sprinted to new records, and silver followed with even more aggression. When gold leads a fear trade, silver often follows with a bigger personality. So what does this era mean for you? Time for honesty. Are you in silver because you think you can flip it in 2 weeks? Or because you believe the rules of money are changing? Put it in the comments. Are you a trader or a holder? And if you've had success, share your story to keep others motivated. Now let's zoom out to the banks are broke idea, because it's often thrown around loosely. Banks rarely fail because of a sudden catastrophe. They fail because of mismatches: short-term liabilities, long-term assets, and confidence. Fractional reserve banking means banks keep only a fraction of deposits as reserves and lend the rest, expanding credit in normal times. That system can run for decades until confidence gets tested. The uncomfortable truth is that it assumes not everyone asks for their money at the same time. Most days that works. When fear hits, it gets stress tested, and when assumptions crack, hard assets suddenly don't look old-fashioned anymore. You might be thinking, does this mean fiat currency ends tomorrow? No. Fiat systems are resilient. Governments have tools, regulations, emergency facilities, and the power to change rules mid-game. The more realistic risk isn't disappearance, but persistence with declining purchasing power as the system patches itself with new policies and narratives. That slow erosion breaks people more effectively than any apocalypse headline. And while we're on patching, let's talk central banks. One underappreciated story is how expensive balance sheets became when rates moved. When policy rates rise, central banks can end up paying more on reserves than they earn on older assets. In the US, public filings describe a deferred asset reflecting cumulative losses. Why does that matter to silver? Because it's a confidence issue. When institutions meant to look boring and stable carry large accounting losses, uncomfortable questions surface. Credibility is the currency behind the currency. This isn't just a US issue. Major central banks abroad have reported significant losses as well. That doesn't mean they go bankrupt like private firms, but it does mean they have credibility limits. Back to silver. When credibility is questioned, people reach for assets that don't require trust in committees. Gold does that. Silver does too. With a second engine, it gets used. Gold mostly sits. Silver gets consumed, dispersed, and often not economically recycled. That's why silver can swing so violently between monetary metal and industrial commodity. So what about the suppression is over narrative? Here's my view. Markets can be influenced, incentives matter, but turning it into a comic book villain story oversimplifies reality. What actually happens is that paper markets set reference prices until physical frictions become impossible to ignore. Then you see premiums, spreads, delivery delays, and cross-market gaps. Look again at those overseas premiums. That's not a slogan, it's a signal. Now the historical comparisons, some say this is just like 1980 or this is just like 2011. If you only look at chart shapes, everything looks the same. But adjust for inflation and the picture changes. Many estimates put the inflation-adjusted equivalent of the 1980 spike in the high 100s today. With silver near $110, you could argue we're closer than people assumed, but 1980 was a different world, different structure, leverage, regulation, and far less industrial use. At the same time, don't get arrogant. Vertical markets punish late buyers. That's why I repeat this message. Don't panic buy, don't panic sell. Decide what silver represents in your life. Insurance? Trade? Long-term store of value? Your behavior should match your reason. Let's touch on another comparison. Silver versus crypto. Depending on the time frame, silver can match or beat certain crypto returns or lag badly. Cherry-picked charts are traps. The real question is what each asset protects you from. Crypto bets on networks and policy tolerance. Silver bets on scarcity, utility, and distrust. Different bets, different risks. Gold and silver surging to records amid geopolitical and policy uncertainty tells you the hard asset reflex is no longer fringe. People are questioning whether bonds and cash are automatically safe. So what should you do? First, focus on process, not prediction. Prediction feeds ego. Process keeps you alive. I don't act on anonymous rumors. I watch spreads, availability, volatility, and incentives. And I size positions so pullbacks can't ruin my life. Second, recognize the trap of taking profit just to feel smart. If you're selling because you need the money, that's real. If you're selling because you're scared and don't understand what you own, that's the market shaking you out. Third, remember there are players bigger than you and they aren't emotional. When silver is scarce in one place and expensive in another, someone is hedging a supply chain or protecting a balance sheet. That's the real economy. Now let me reframe the end of fiat idea in a useful way. The end of fiat is dramatic. What's more likely is a long period where fiat loses credibility and governments respond with more complex money, more digital rails, more rules, and more incentives to keep wealth inside the system. In that world, physical assets, especially small divisible ones, matter more. That's why silver matters. Not because it's magical, but because it's tangible. It doesn't need permission, passwords, or servers. So here's my question for you. If silver pulls back hard, 10, 15, even $20 in a week, do you run or do you position? Answer honestly in the comments. And if you've had success, share it. One last quick note before we land. We do offer members-only videos made by a separate team that dives deeper into research and cross-checking. Those are for premium members, and the join link is in the description. Let's close calmly. Silver is behaving like a market trying to reprice itself. Cross-market premiums point to real stress. Volatility tells you the ride will be rough. The macro backdrop, debt, politics, and central bank balance sheet scars explains why hard assets are back in focus. None of this is permission to act recklessly. Don't chase, don't dump, don't let ego drive decisions. Build a plan that fits your life. The market's job is to transfer wealth from the impatient to the patient. Stay calm, stay curious. Don't let the crowd rent space in your head. If you made it this far, hit subscribe so you don't miss the next update. Check the description for bonus links, the premium WhatsApp channel, and membership options. And tell me in the comments, is silver rewriting the rules, or is this just another cycle that will humble everyone again? And finally, the necessary note. I'm sharing my perspective for education only. I'm not your financial advisor. I don't know your personal situation, and I'm not telling you to buy or sell anything. Think for yourself. Double-check your numbers and make decisions you can live with, especially in markets that move this fast.